Welcome to this in-depth guide on the after-tax margin calculator. Whether you are a business owner, investor, or someone who wants to understand financial efficiency better, this video will break it all down in a simple and practical way. In this video, we will cover what after-tax margin is, why it is important, how to calculate it with a real example, and how it compares to other financial metrics. Make sure to watch until the end to learn how you can use this calculator effectively and improve your financial decision-making. Now let's get started. 1. What is after-tax margin? To begin, let's define after-tax margin. This financial metric measures the percentage of revenue that remains as profit after all expenses, including taxes, have been deducted. It is a useful way to determine how efficient a company is at turning its sales into actual profit. The formula for calculating after-tax margin is after-tax margin equals net income after tax / revenue x 100. Net income after tax is the final profit after deducting all costs, including taxes. Revenue is the total amount of money earned before any deductions. For example, if a company generates $500,000 in revenue and has a net income of $100,000 after paying taxes, its after-tax margin would be 100,000 / 500,000 x 100 equals 20%. This means the company keeps 20 cents in profit for every dollar earned after paying taxes. 2. Why is after-tax margin important? Now that we know what after-tax margin is, let's explore why it is such a critical metric. Evaluating business efficiency is one of the main reasons after-tax margin matters. A higher after-tax margin indicates that a company is managing its expenses well and operating efficiently. Companies with strong after-tax margins are generally better positioned to reinvest in growth, expand operations, and generate shareholder value. Investment decision-making also relies on this metric. Investors often look at after-tax margin to compare companies within the same industry. A company with a higher margin is often seen as more profitable and financially stable. 3. Real-world example calculation. To make this concept clearer, let's go through a real-world example. Imagine a company, ABC Corporation, has revenue of $800,000 and a net income after taxes of $120,000. To calculate the after-tax margin, we use the formula after-tax margin equals net income after tax / revenue x 100 equals 120,000 / 800,000 x 100 equals 15%. This means ABC Corporation retains 15% of its revenue as profit after all expenses and taxes. If another company in the same industry has an after-tax margin of 10%, ABC Corporation would be considered more efficient in managing costs and generating profit. 4. How the after-tax margin calculator works. Instead of manually calculating after-tax margin, you can use the after-tax margin calculator available on calculator6.com. Using the calculator is simple. Enter the total revenue of the company and input the net income after taxes. Click the Calculate button, and the tool will instantly display the after-tax margin as a percentage. Now it's your turn. Visit calculator6.com and try the after-tax margin calculator yourself. If you found this video helpful, make sure to like, subscribe, and hit the notification bell so you never miss an update. Also, let us know in the comments what financial or health-related topics you want us to cover next. Thanks for watching, and see you in the next video.